All right, guys. Welcome. Alexa, pause. Welcome to tonight's training, guys. We are almost at the end of the year. We are officially almost into tax season as well. And I'm so excited. I'm a little under the weather. My son is under the weather. It's definitely something going around. But I definitely did not want to cancel tonight's call because we just have a lot that we need to cover on tonight. And so, welcome everybody who's on. Hope everybody's having an amazing day. Excuse my little sniffles here. Um, but I think everybody has been able to get your prepare logins successfully, except like maybe one or two people who's waiting on a P10 number of what sort. So no worries for you. Tonight we're gonna do a little catch up and a real in-depth training on the taxes and tax season. And I know you guys have been seeing a lot that's been happening, a lot that's been going on. And my goal as a tax mentor is to ensure that you are prepared for not just the basics and the foundations, but that you're prepared for any situation that may arise. Not to say one is going to arise, but the main thing is if this is your first year doing taxes, I was telling someone earlier today, you want to ensure that you know and understand that marketing is going to be everything. You have to make sure that you know that you have to market, you have to promote, you have to build relationships because we are in a relationship business. Okay. So, as we're kicking off, I do want to talk a little bit about the dependency because there's a lot of changes, especially with the Big Beautiful bill. And so when you're filing your clients, oh, excuse me, guys, 1 second. Let me grab me some Kleenex real quick. So sorry. All right, guys, I'm back. So, just some little notes for dependencies. We've been seeing a lot of different posts go out. Some people know what they're talking about, some people don't. Just be careful when you are looking at information, sharing information, repeating information. You want to make sure you fact check. Always go to the IRS site if you want to fact check any information. We've been hearing a lot, just some stuff I've been seeing people say about dependents, and I want to make sure everybody is clear by the IRS term, okay? A dependent is a qualifying child or relative who relies on a person for financial support. So, in order for your taxpayer, which is your client, to claim a dependent for any tax credits or deductions, that dependent must meet these specific requirements, okay? Now, some basic requirements, of course, it must be a U.S. citizen. Nobody else can claim um, no, a person can't be claimed as a dependent on more than one return. This is the issue right here. Somebody was talking about this, unless there's an exception. Let's go to that exception because everybody is saying, or some people are saying, hey, did you know that you can file your son and somebody else can file your son too? That's not always the case, okay? It's very rare. All right, guys, welcome. Alexa, pause. Sorry, guys, I don't know where that came from. Training, guys. We are boom. Okay. Um, it's an exception. If you can be claimed as a dependent by another taxpayer, you can claim someone else as a dependent if the person who can claim you or your spouse, if filing a joint return as a dependent, files a return only to claim a refund. Let me read it again because that's a little weird there. Okay. If you can be claimed as a dependent by another taxpayer, you can't claim anyone else as a dependent, okay? Even if you have a qualifying child or qualifying relative, you can't claim that person as a dependent. So let me give you an example. If Cedric, if I'm a child and Cedric is going to claim me, but I'm an adult. Let's just say he's going to claim me. I live with Cedric, pretend we're not married. I live with him. He's been taking care of me. He's gonna file me, and I have a son. Just because I have a son, I can't file another person as a dependent because I am being filed as a dependent as an adult. Okay, does everybody understand that? The only exception is if you can be claimed as a dependent by another taxpayer, you can claim someone else as a dependent if the person who can claim you as a dependent files a return only to claim a refund of income tax withheld or estimated taxes paid, which means they're not trying to get the earned income. They're not trying to get the child tax credit, additional child tax credit, or earned income credit. So that's simply just saying, guys. Now, when you do it in the software, the software is going to automatically populate everything that your client is eligible for. Don't worry about that. Okay. But when people come to you wanting you to do crazy stuff, shut it down. Period. Just shut it down. If this is that person's qualifying child, just because it's their child by relationship, you need to verify that that child lived with that parent for at least 6 months and that that parent took care of that child for at least 6 months or more. Okay. That's what you have to ask your client. So to be a qualifying child and to qualify as a dependent, it must be their son, daughter, stepchild, eligible foster child, brother, sister, half sister, or brother, stepbrother, stepsister, adopted child, or the child of one of these. So anywhere like kind of like in the family or by foster relation. Child must be under age 19 or under 24 if a full-time student. If the child is disabled, it doesn't matter how old they are. They can file them at any age, okay? Again, live with them for more than half of the year. Receive support from them for more than half of the year, okay? It is so important, guys. So I've been seeing some weird stuff out here. I just want to make sure that you guys understand, excuse me, and that you guys know, okay? Now let's look at a qualifying relative because it's different from a dependent. A qualifying relative is not a qualifying child, which means it's not one of these up here. Okay? Not one of these up here. The member of the household or relationship, that qualifying relative must have to live with you or the taxpayer. I'm talking about your client as a member of their household all year to be classified as a relative. So if that qualifying relative works or receives some type of income, that income cannot be over $5,050 if your client is filing them. Okay. And that qualifying relative gets more than half of their support from you. Okay. Very important. As you are completing in the software and it says, what's the relationship to the taxpayer? Once you choose the correct relationship, the system will automatically know what credit this person is eligible for. Okay. Now, that's just that one. This is for dependency. Okay. Dependency. So, most of the time, guys, I've never really had any issues with people filing people. Most of everybody who my clients, and it's a lot of clients, they file their own children, their grandchildren, their nieces, nephews. I've had some people who filed their parents before. I've had some people who file like as a qualifying relative. I had a couple of people file those as well. Recently, the IRS is now auditing people who file anybody. Like it could be your own child, and you can absolutely get audited as well. Okay, so just FYI, just FYI on that. So that's that one. Now let's go into our incomes. Okay. Now, most of the time when you're filing taxes for your client, normally they're going to be filed by standard deduction. Again, the system knows what type of should they be itemizing or should it be standard deduction. Okay, the standard deduction, for those who haven't watched the course, is only a specific dollar amount that reduces the amount of income on where your client is taxed. So the standard deduction for, let's say, this year, I want to see if it's on here. I think it's like 12. Normally last year was like 12,000. I'm gonna find it for you guys. They normally just have the amount on here. It's crazy. The amount definitely should just be right here for us to look at. Let's see. Okay. We want to see what it is on the IRS side, nowhere else. Okay, so for the 2026 year, standard deduction increases to $32,200 for married couples filing joint. For single taxpayers and married individuals filing separate, the standard deduction rises to $16,100, and for head of household is $24,150. So, let's say for instance, okay, let's say for instance, you have a client, they had a lot of surgery this year. I mean, like so much they had to pay out of pocket. Let's say they went through IVF, right? Excuse me, guys, let me blow. Okay, so they went through like IVF, and they need to write off $60,000 in expenses. No business, just their receipts for doctors, nurses, surgery, whatever. They're no longer in the system automatically. They're no longer now under standard deduction. Okay. Now they'll automatically be under itemization. They're not going to be itemized. Oh, it's crazy. They're now going to be itemizing their returns, which means now they're no longer under standard deduction numbers. The system is automatically going to make sure that now they're itemizing. So they're going to start receiving all type of credits, and the amount owed is going to start coming down based on how much money you put in that they have in expenses. Okay, let's actually log in and look at that real quick. Let me see my login. I'm not logging anywhere. Anybody got questions while we're tapping into this? Any questions? Let me make sure everybody can unmute. Yeah, you all can unmute. Let me share the login. Okay. So let's look at Ms. Bankston's return. Let me show you an example of if she no longer qualifies for standard deduction. It may not show me everything because it's a previous year, but I just want to show you guys some stuff. So let's just say here in the federal section, okay, and we go to payments and estimates here. Oh my gosh, come on. Payments and estimates. Payments and estimates. There we go. Okay. And let's just say she has a lot of receipts for some things that she had to pay out for like different bills. Okay, like for different bills. She has all her receipts. You looked at the receipts, you calculated everything, or she calculated however who did what. And you see that she qualifies, she needs to be, she wants to write out everything. Like you have no clients that say, I want to write off all this, all this, all this. But if it's not, what I tell my clients, if it's not over the standard deduction amount, I'm not gonna even, I will add it in because they want me to, but it's not going to do anything to the numbers. Okay. The only time when a client is itemizing that it's going to affect their refund or affect the amount that they owe down or bring it down is if that amount is more than the standard deduction amount. Okay. So for her, like we itemize her. We itemize her. And I'm going to show you some different stuff here. Right here, like medical, dental, vision expenses. You're able to go in and add all of these different out-of-pocket expenses that your client may have. Okay, different stuff. And this is not under a business, this is a normal client, because there's many things that clients pay every single year that they don't write off. Like They don't write off their mortgage interest forms. You know, a lot of them don't write out medical, dental, and vision expenses. Like right here, choose, itemize, or take the standard. See, for us, I say use better of standard deduction or itemize, because if I'm putting the numbers in, the system will know easily, and this is automatically calculated what they should do. Okay. But let's just say they pay different sales tax. They got real estate property and other sales tax and different things. They want to write off everything. They want to write off property taxes. They want to write off donations, employee business expenses. Let's say that they're a W-2 employee, but they still have expenses, reimbursements, and things that they have to use for traveling, like gambling losses, estate taxes, investment fees, expenses. All of these can be written off legally if they have the receipt for it. Okay, legally if they have the receipt for it. And so that is standard deduction. Standard deduction literally means if the IRS will calculate a set amount of adjustments for everybody. And if a person has more expenses, or they call it deductions, then the standard deduction amount, it automatically activates them to be itemizing, which means that they're now listing every type of receipt that they have. Now, you may have a client come in, they don't have no receipts and nothing, just a W-2, their children, that's it. Of course, they're going to automatically be standard deduction. Okay, they're going to automatically be standard deduction. So that's that one. Okay, now let's take a look at the child tax credit. Very important. I'm free anytime. Let's take a look at the child tax credit, because it's higher this year. You guys probably been seeing us talking about how refunds will be higher this year. But this is what I want to be clear with everybody. Refunds are going to be higher if the person has done what they were supposed to do, meaning that they pay taxes. Okay? Just think about it. If these are refundable credits, okay? These are refundable credits, meaning this is what gives a person money. This is not a deduction that reduces their tax bill. This gives them money. So let's say, for instance, you have a person, they worked all year, no taxes taken out or not enough. And so let's say, based on them making $60,000 a year, they should have paid $12,000 in taxes, just for an example. Let's say the child tax credit, let's say for just one child, and they meet all dependency. I'm going to go to the actual numbers. I'm going to show you a prime example here. A prime example. I want to do prime example. Okay. Did I miss it? I got it saved in my phone so I can really just pull it up here. Oh, child tax credit definitely should have been under here though. Hmm. I want to make sure that's the right number for this new year. Hold on, guys. I got it saved on my phone. Recently saved. Okay. So, yeah, right now, child tax credit. Oh, this may be the income EIC credit I'm looking at. Oh yeah, that's what I'm looking at. Our income credit. Okay, so let's say, for instance, if the child tax credit is $2,200 per child, let's just say that person has one child, $2,200. How can they get that full $2,200 credit? Well, here's how. If they made $60,000 and they should have paid $12,000 in taxes, guess what? They should get the entire $2,200 back plus whatever credits they qualify from. But how do they not get that full credit? Because that's what people don't understand. They think the IRS is going to just give you that full credit no matter what the scenario is. That's wrong. Let's say they only paid $10,000 in taxes and they should have paid $12,000. Now they're negative 2,000 that they owe the IRS from the money that they've been paid out. Okay. And instead of getting 2,200 for that one child, they're going to get 200 because 2,000 of that is going to go towards their negative debt. Now, if they didn't even have a child, they will be negative $2,000 in the red, meaning they will owe the IRS. But because that refundable credit came, that refundable credit from that child came to get them out of the red into the green, but they won't see the entire 2,200. Okay. So that's where a lot of preparers are confusing people. People don't understand, don't know what that means, how to calculate that. But that's what that means. So in order, you have to qualify for the full amount. Okay. And that's just a child tax credit. Now let's think about the additional child tax credit that you get in additional to the child tax credit. That is a separate amount. And so in order for you to even get, look at this, you must have earned income of at least 2,500 to even be eligible for the additional child tax credit. Some people, when they file their taxes, they don't even have earned income. Okay? They don't even have earned income. And so that is how you calculate it. But the system does it. You don't. I'm just giving you guys an example. Because you may have a client that come and say, well, my sister got 3 kids and I got 3 kids, and I'm trying to see why her check 12,000 and mine only 9,000. Well, let's see why. Okay, we can see why. All we got to do is go to our return. We're going to go over here to the summary. Not e-file. Oh, God, hold on. Let me do this. We're going to go over here to the summary and we're going to take a look at why. Okay, if your total amount that you made is this amount, okay, but in taxes, you only paid, page 2. In taxes, you only paid $6,559. Let's just say, for an example, you let's say out of 144,000, you only paid 6,000 in taxes. Of course, you're not gonna be able to get the full credit if you had a child. Now, this person don't have a child, so I'm just using it as a scenario. Okay, so this is how when you're completing a return and you get to this section here, this is how you can see what they qualify for. You can go to page 1. This is like mostly the numbers that you've entered in, but then when you get to this page 2 right here, okay, you'll really see. You'll see, okay, this is how much they gave them for child tax credit. This is how much they gave them for additional child tax credit. This is how much they gave them from the earned income credit right here, EIC. If they had American Opportunity or Education credit, this is what they gave for the education credit. See, you'll be able to see the amount that they were able to get fully. So if in case they ever ask, well, how much did I get for that? Here it is. Okay, here it is. So basically, guys, system does everything. Never forget, the system does everything. It's so important to know that. So you don't have to be right here calculating anything. Okay, you don't have to be around here calculating anything. Now, I do want to pull up the earned income credit, and I like to look at the IRS site every time because I go based on facts, not just by what everybody else is saying. Okay, for the earned income credit, okay, the max amount is $8,231 for qualifying taxpayers who have 3 or more qualifying children, up to $8,046 for the tax year 2025. So, what does that mean? If I don't have 3 or more kids, I'm not gonna get no money. No, they're just saying they increased the amount this year with that big beautiful bill. Let's just look at earned income credit, just period. Okay, let's just look at the chart period for 2026 year. Okay, now earned income credit is also refundable credit. Remember that it's also refundable credit. In order for your person to qualify, they have to have earned income, meaning they have wages, salaries, tips. They 1099, okay, income from a job. Maybe they didn't get taxes taken out. That's when your 1099 Any C's come or 1099 miscellaneous. Also earned income is money from their self-employment. If they have a business, if they are a minister or any type of side business, that is considered earned income as well. Okay. Also, non-taxable combat pay. We don't have it anymore, but some people used to go overseas and work. Oh, so cute. And so if that's them, guess what? That's earned income. So after you put all of their income over here in the software under the income section, the system calculates everything for you. I'm not going to stop saying it so that you know it. It calculates every single thing for you. Okay. Now, Social Security is not earned income, but it's income. It's not earned income. Interest and dividends, unemployment, child support, alimony. It is income, but it's not earned income. It will not activate the earned income tax credit. Okay. So here are maximum amounts. If your taxpayer has one child, the max, okay, the max that they can make if they're single, head of household, or married, filing joint, or widow, or married, filing separate, or widow, is 50,000. These numbers went up extremely this year because they were never this high. This means if your client makes over this, they won't qualify for the earned income credit. They'll still probably qualify for the child tax credit, additional child tax credit, but they won't qualify for the earned income credit. Okay. See, for one child last year it was $49,084. Now it's $50,434. 57,000 filing married filing joint. 56 married filing joint last year. So it looks like the highest one was 2 kids. It went up like $2,000. But married filing joint came down for 2 kids. See, it was 60. It's 64 now. Oh, I'm sorry. No, it went up 62 too. Yeah, this one was the highest one. It went up 2,000. Went up 2,000. So how do they get the max? How do they get the max? How do they get the max? If they paid enough taxes, if they don't owe. If they don't owe. And they may get even more than these amounts because if they overpay in taxes plus these credits, that's how you see we do the big refunds legally, 100% legal. We don't have to alter anything. Okay. We don't have to alter anything. Now, education credits, 1098T form. Okay. Make sure your client has a 1098T form. If them or their dependents were in school, you want to know what type on the 1098T form. You also want to ask them what type of tuition did you have to pay anything out of pocket, any moving, any books? Did your daughter, your son have to pay anything out of pocket? Because if so, that can also be added and that can increase the amount, not just of the American Opportunity Tax Credit, but that can increase their tax refund. Okay. Now we got other credits like the Clean Energy and Vehicle Credit. You can go on the irs.gov site to look up more on this because you may have clients. You can ask them, hey, do you have a smart car? Do you have a Tesla? Do you have an electric vehicle or a fuel cell vehicle? You could possibly qualify for a tax credit depending when you bought it. Do you have those things at the top of your house? I forgot what they call solar panels. If so, you could possibly qualify for the energy improvement tax credit. Okay. So many different credits is out there. And don't forget that the software is going to ask you yes or no, yes or no. So you're not going to miss anything. Okay. You're not going to miss anything. Everybody's on here unless you have been with me for more than 2 years. You have to do the yes or no wizard because I have it set so that nobody misses anything. Okay. Now, again, our business credits and deductions. So much, guys. So much. Okay. So much when it comes to business credit, business deductions. Expenses are just the beginning. There are many other credits. The fuel credit is really big right now. It got a lot of people audited because a lot of people didn't qualify for it. If you got like truckers, if you got 18-wheelers, people who use diesel, depending on the type of fuel they have, you can definitely go in here and see who is eligible. This will add an extra 2 to 20,000 on their return extra if they qualify for this. Okay, but make sure you know who isn't eligible as well. It's very important. Um, Not only that, I don't do the ERC credits. We have a lot of people who do, the ERC credit. That's more so for business, not 41s. I don't really do that. But there are other credits as well that qualify for business credits that can be claimed. Some of these are like for C Corps and S Corps. But just know the home office deduction for your clients who may have a home office. They do a lot of on the road. So they definitely want to file their mileage. Photo shoots, anything that they have spent on the business. Tell them to go back, tell them to print out their receipts because it can legally be filed. Okay, it can legally be filed. Now, let's talk about this because I know we don't really talk about this a lot. But what if a client don't have enough income? Like enough income. Okay. So let's say for instance, you have a person who's a business owner and they only told you, hey, I think I made about 12,000. Well, 12,000 is okay, but if you really want to activate all your credits, you need some more money. So you may say, are you sure this is it? Go and pull all your receipts, all your cash apps, all your business Zelles or personal Zelles, everything that you have where you made money so that we can add more income because more income unlocks credits. Now, remember this too. If a person doesn't have earned income, they can't even get the earned income credit. Okay. They can't even get the earned income credit. So important to know that. So if you guys go on to irs.gov, if you've been through the training here, the first section I told you how to sign up for IRS eWire News. And if you sign up for that, I'm pretty sure your email is loaded because that's all we do all the IRS do is send us different stuff. Okay, that's all they do is send us stuff. Also, when you are putting in, let's say for people who get distributions, like their IRA distributions, they pull from their 401k or what have you. What you can do is ask or research if they are in a state that was a victim of a natural disaster. Okay, like let's say Florida. We all know that Florida is always getting hit with natural disasters. Okay, uh, so what you could do is, let's say I have a client. My client is now in a negative. She owe about $4,100 because she didn't pay enough in taxes, and then plus she got a distribution. So now she in a negative for $4,100. Well, I know she's in Florida. What I'm gonna do is I'm gonna go and I'm gonna research in the year we're doing. We're about to do 2025 year. I'm gonna go and I'm gonna see what type of hurricane or natural disaster hit in 2024. I'm sorry, 2025. If it hit in her state, guess what? In 2025, here's a gem. That entire tax on that distribution now becomes zero. Okay. It now becomes zero. So let's say what she was owing 4,100 because she didn't pay in any taxes on that distribution. She was in a state that was a victim of a hurricane. Boom. I'm able to go in when I am putting that information in. Hold on. It's going to be at a 1099R. Okay. But I'm getting ready to add that 1099R. Remember, we're only doing data entry. So we're only doing what we see on that 1099R form that our client gives us. Let's just say this is our client's address here. And let's say on that distribution, she got $4,100 and she didn't pay no taxes on it. Taxable amount $4,100. This is I'm copying what's on my 1099R form. Okay. To be was checked for total distribution. Zero taxes was withheld on that. Distribution code was 7. Okay. It was an IRA. That's what it says on the distribution. None of this is on the distribution, so I'm not even going to put any of this on there. If it is, I'm going to add whatever's on there, and I'm going to click continue. Now, I can't click continue because it's a 2024 return, but when it pops up, the next thing I'm going to say, were you affected or distribution by a natural disaster? You're going to click yes. If they were in a state that would declare a natural disaster for that year, you can click yes. And then what's going to happen is you're going to have to put the natural disaster code. So you're going to have to find which natural disaster is in the year. that you want to find, and you're going to copy that natural disaster code and you're going to enter it in. Now, you just got your client from owing $4,100 to now zero. That's a gem, guys. That's a gem. And that's 100% legal. Okay. Any questions on that? Any questions on that? Okay. Now, with everything that's going on with due diligence,
Brianna.
yes, ma'am. Hey, Keisha.
Hey, you said the disasters for 2024 for this year coming for 2025 or
Well,
2024
no,
for last year?
it'll be 2025. So when you, let's say when you're doing taxes next year, it'll be for 2025. So when you go on this site, you're gonna look up for any natural disasters in their state for that current year, which will be 2025. And then you find one, you just copy the DR number, which is a natural disaster code, and you are entering it in on the software. Boom, and you're gonna see the amount that they were owing or the amount that was low is gonna increase now because you're able to put a natural disaster on that 1099-R.
Okay, because I know last year I had a couple from Georgia that when they had that big flood thing, and I
Yes.
used the same site, so I just want to make sure. Okay,
I use the
gotcha.
same site right here, and I just copied that code. Did
Right.
you did you
Okay.
did you do that? Did you add the natural disaster on?
Then I had to put in that code. It was the same code. It was the code that they gave us for Georgia that I had to put in. Yep.
Yeah. Okay. Great. Yep.
Okay.
Yes, ma'am. So it
Okay.
should help them not. It should help them not owe taxes on that distribution.
It did a
Yeah.
lot.
Yeah, for
Mhm.
sure. A lot of people don't know that exists, guys. That's great to know because your client sometimes when they be afraid when they get the distribution because like, oh, I ain't paying no tax. I know tax gets charged tax time, but if your tax preparer know what to do, they'll be okay. Okay, they'll be okay. All right. Now, if I were you guys, I'll go to the IRS.gov and I'll go to due diligence section, and I would just start doing all due diligence trainings just to know as a preparer to make sure you're following all your P's and Q's. I actually have some due diligence trainings that I've done. I'm gonna go ahead and I just downloaded them all. I'm gonna put them on in the Facebook group so that you guys can watch those too. But definitely start. One thing about due diligence is it cover you as the preparer because before the IRS was just coming after the taxpayers for whatever the preparers were put on the return. Now they're coming after the preparers. So you want to make sure that you are doing proper due diligence. We want to make sure we're not falsifying any information, and we just want to make sure we're following protocols. So if I were you guys, I would recommend everybody for the Christmas holiday take 30 minutes to an hour out of your day to definitely go over the due diligence training. Okay, so everybody's actually locked in. We really don't have anybody else, maybe about one or two people who we have to get them access to the software, but everybody should have their access. You guys are welcome to go in and start doing dummy returns. You can't submit anything, so don't worry about that. You can go in and start doing dummy returns, playing with it. We can deactivate those before we actually start the tax year. Yeah, we can deactivate those before we actually start the actual tax year. Other than that, guys, anybody else have any questions?
How can you go in and do like the dummy to do the dummy returns?
Okay, so you click when you log into the return
Uh huh.
and you just start new return.
Uh huh. Oh, okay. Okay. Just like the regular way. Okay. I thought it was like a.
Oh, Keisha, I know that I thought that was somebody else asking me, girl.
Yeah.
Yeah, like dummy return, you know like a regular client, and we just go in and deactivate it.
Oh, okay. Yeah. Gotcha. Okay. That was something new.
No, that's it, same thing. Okay, Diamond, no worries. I see you say phone cut off, no problem. All right, guys. Well, if not any more questions, I just want to hop on with you guys, go over that quick detail, quick information. If you guys have any trouble with anything, please let me know. All right. Oh, speaking of that, guys, we won't have class next week because next week is Christmas time. So you guys enjoy your families. Um, we definitely gonna have class that following week because or meetups because we finna get ready to get rolling January 1st. I tell people go ahead and be reaching out to your clients. Send them Merry Christmas, Happy New Year. So excited for you. Let's get this tax ball rolling. All right, guys. Love you so much. For those who will catch the replay, I'm gonna post it in the group. And you all have a Merry Christmas. God bless you.